Welcome. I am Ernie Goss, research faculty member here at the Craig School of Business at California State University, Fresno. We're here in Fresno, California, beautiful Fresno, California. We're reporting today for our survey of businesses in the San Joaquin Valley, Economic Indicator, which is a leading economic indicator for the four-county area. Now, what is the index for the month of September to be released today, the first business day of October? The index was up for the month of September, and that's a good signal. In fact, it was up to its highest level since March of 2013. Of course, that's a good signal for the economy expanding. And of course, the Fresno, the San Joaquin Valley area, some economic real issues in the past since the recession, since it began in December of 2007. But anyway, of course, all of you know that the drought has been having significant impacts on the area. But you know, we asked this month, we asked the businesses, well, how has the drought been having a significant or even a negative impact on your businesses? About 35% indicated that it was having a negative impact on their businesses, and that was last month. This month it was down to 28%, so still obviously too high. 28% of the businesses reporting having negative impacts on their businesses from the drought and fallout from the drought. As I said, the overall index, which is a leading economic indicator for the month, was up for the 10th straight month, of course, up above growth neutral for the 10th straight month. The overall index moved from 57.6 to 58.5. Now, the index spans from 0 to 100. Anything above 50 is growth positive, 50 is growth neutral, below 50 is growth negative. So 58.5 is a good number, indicating we're going to see some growth in the four-county area, the San Joaquin Valley, for the next 3 to 6 months. Of course, that includes the fourth quarter of 2014. Now, if you see here, if you look at the graph that I've got here of the chart of the numbers, the leading economic indicator, you'll see that it has increased for the third consecutive month. That's in the red. In the blue, you see the U.S., and of course, they're both moving up at a pretty brisk pace, indicating again that this economy is continuing to expand. Now, there are some bumps in the road, and one of them is the inflation gauge. The inflation gauge was down from 66.0 last month to 59.4. And you say, well, why is that bad news? Inflation, the inflation index is down. Now I'm getting a little concerned, many economists, especially on the Federal Reserve Open Market Committee, the Federal Reserve is getting concerned about not enough inflation. So if that index continues to move downward, that's a real concern that the economy, at least the economy that the Fed cares about, is slowing down. Now, again, there's a mixed message there. Inflation's coming down, yet the economy is moving higher. But we'll have to see what are the reasons why that inflation gauge is coming down. Average weekly wages. Now, this was a very good number for the August over August. Over the past 12 months, average weekly wages have grown by 3.9%. Now, that's almost twice the rate of inflation. That is a strong number. That's much better than what we're seeing in the U.S. Numbers. That's better than what we're seeing in the California numbers. So that's a good reading for the month, for the last year in terms of average wages. The unemployment rate has come down by 1.6% over the last year, and that, of course, is good. And here's one of the oddities coming out. I shouldn't say oddities. It's different from what we're seeing in the U.S. The participation rate's going up. In other words, we're not having near the percentage of workers withdrawing, getting discouraged, leaving the labor market. In other words, they're either looking for a job or they've got a job. So that's contrary to what we're seeing in the U.S., and that's a good signal that labor force participation rate remains strong. Now, in terms of manufacturing, we're just still not seeing enough growth in the San Joaquin Valley. Still 8,000 jobs down in manufacturing from before the recession began. Construction softened a bit for the month, and that's a concern We're still not back to pre-recession levels for the construction industry. Wholesale trade looking strong. We're seeing growth there. Temporary employment, still seeing too much of that. In other words, not as much full-time employment growth as we'd like to see. So some of those jobs that I just talked about are part-time, and of course that's not what we'd like to see, but it's better temporary than not at all. So I'll take those temporary jobs, and I think you probably will as well. Now, what to watch out for in the next month? Keep an eye on that Case-Shiller home price index. That number's been coming down. The housing sector's weakened. The growth is weakened in the San Joaquin Valley. That's a concern of mine. That number is coming down a bit more than I'd like. I think it needs to come down, but not like what we're seeing. Pretty dramatic decline there. Now, it's still growing. Prices are still growing according to that index. Keep an eye on the jobs numbers that come out this Friday. Now, if that number is less than 100,000 jobs added for September, that's clearly a negative sign. More than 200,000, that's a real good sign. So anything between 100,000, 200,000, sort of neutral news. Look for wage growth. Look in that employment report that comes out Friday. Watch for wage growth, year-over-year wage growth. Very important. That's an inflation gauge. That's a number the Fed is watching. That's Janet Yellen, head of the Federal Reserve. That number, if that number comes out and it's less than 2%, again, not strong enough, needs to be over 2%, needs to be something like what we're seeing in the San Joaquin Valley. Keep an eye on the 10-year Treasury, as I've always talked about each month. That tells us whether the economy is weakening, the global economy, whether it's strengthening. If it did ever get back to 3%, it's been below 3% for quite some time. If it got above 3%, of course, that's telling you a lot of inflation. It's well below 3%, telling you there's a real concern out there about what's going on in Hong Kong, what's going on in Russia, or I should say the Ukraine as a result of Russian action there, and of course what's going on in Syria and the Iraq, what's going on in Iraq as well. Now, GDP growth comes out on October the 30th. Keep an eye on that number. Look at it. Take a measure of it. If the growth is annualized and season adjusted, if that number happens to be, say, above 3%, that's very good. Now, if it's below 2%, not so good. Neutral, 2 to 3%. So there's where we're talking about anywhere between 2, 2.5, 2.75, 2.8, neutral. Above that, 3% certainly strong. Now, the risk, housing market. I'm really concerned about the housing market. Watch those cues, I should say, and keys as well, coming out of the Census Bureau, coming from Case-Shiller. Look at trade embargoes, the Russian trade embargoes, whether they're embargoing our goods going into Russia or whether we're embargoing their goods coming into our country. China, Hong Kong again. Europe slowing down too much there. They move into recessionary territory, which I think they are. That's not good for the U.S. economy. Much stronger U.S. dollar. They're still fleeing. Everybody's fleeing into the U.S. dollar. Again, as I said before, healthiest source in the glue factory. Our economy is not strong. Our dollar is not as strong as you'd like, but it's stronger than the others. Moving into that, buying our stock, buying our bonds, driving our yields down, driving our stock prices up. Everybody said, well, why is our stock market up? No other place to go. You've got low yields. You've got a lot more uncertainty outside the U.S. than you do in the U.S. Farm income, as a result of that strengthening dollar, that's pushed farm income down. At least we're seeing that moving downward, the growth there, and even into negative territory for certain types of farms. Grain prices down by 30% over the last year. That's going to show up particularly for those areas of the country that are dependent on farm income. Of course, that includes the San Joaquin Valley, where farming is very important. And again, watch the unemployment rate moving down as the participation rate moves down as well. Fortunately for the San Joaquin Valley, it's been moving up, but the U.S. numbers, participation rates are coming down. Watch that number. Well, that's it, folks. It was a good report for the San Joaquin Valley. This is Ernie Goss, research faculty member with the Craig School of Business here at California State University, Fresno. Until we meet again, that would be the first business day of November, November the 3rd. May your economic cup runneth over, and thank you a bunch.